Hi there. In the last video, we've studied temporary versus permanent accounts. And we've discussed that we will study closing entries in this video using the accounting cycle examples that we've used so far. Okay, I'd like to make a question for you. That is, we've prepared in the past videos, chapters, the income statement, owner's equity statement, and balance sheet, right? Based on the adjusted trial balance, right? Well, for example, sales was from the adjusted trial balance, all the expenses the same, right? And our sales minus total expense was net income, right? So far, so good. By the way, I want these numbers to stay here, but as you can see, some of the numbers are developed using the functions, but I want to keep these numbers rather than using the functions. So please follow me. Lock the column S and T by clicking the headers, and then press right hand side button, press Ctrl C to make a copy, and then follow me well. Press right hand side button of your mouse, and then press SS. Then you will see paste special. Here, press V, which is a shortcut key for values. Okay. Then, what up? Okay, done. You can see that previously these are formulas, but now you pasted values. So you don't have the formulas anymore. So even though we change the values here, the values here will not be changed. Okay, cool. That said, my question was, yes, these numbers are from the adjusted trial balance. Then what about this one? Yes, from the adjusted trial balance. Net income from here, owner's drawing from here, and owner's capital ending up. It is based on a calculation, right? Owner's capital, right? Owner's capital is updated, right? At the end of the period based on a calculation, not based on the adjusted trial balance, right? Adjusted trial balance, owner's capital was simply a beginning balance. Oh, I'm saying that owner's capital is not updated to the ending balance when everything else, you remember, was updated to the ending balances, right? Again, everything else is updated to an ending balance, except for owner's capital, right? We know that ending balance should have been 12,360, but here owner's capital is a beginning balance. Wow, that sounds not consistent, right? Then, how can we update this owner's capital to the ending balance? Okay, that's one question. The other question is, as we've seen at the last video, we need to zero out all of the temporary accounts, right? We need to zero out all of the temporary accounts before beginning a new period, before beginning the November 1st, in this case, okay? So let's do that. What should we zero out? By the way, closing entries, let's prepare here. closing entries. What should we zero out? Sales and all the expenses first, and then next owner's drawing and something called income summary, right? So let's pay attention to the zeroing out, the sales and expenses. Okay, then where is the normal balance of the sales? As you can see, sales are found on the where? Credit side, right? Sales has normal balance credit side. Then, as a result, its ending balance is located on the, credit side, right? In total, this is 10,600. You need to make it zero. Then how, again, for educational purpose, I think it would be good to draw a T account. Where shall I draw the T account? You don't have to follow this one. I'm just drawing the T account for your benefit, for your understanding. Currently, what this tabular form of general ledger says is, if we use the T accounts, it is something like you have 10,400 and 200. As a result, your ending balance is 10,600, right? This is what you have. Then, if you wanna make this balance, ending balance, zero, if you want to make this ending balance zero, when this ending balance is some of these numbers minus some of these numbers, right? When you want to make this ending balance zero, what should you do? That's right. You should, here on the debit side, the same amount should be posted. The same amount, how much? Sum of these three numbers, right? By doing this, you can get the sum of the debit total, credit total minus sum of the debit total becomes zero, right? What I'm saying is you need to debit the same amount, 10,600, the sales, to make the sales zero. Okay, that's cool, but can a sales stand by itself? No, we've seen that all of the entries are debit and credit being balanced. This is standalone debit. You cannot leave it alone. Well, we don't have any other tools except for creating another temporary account that is for closing sake. And let's title that closing entry, that temporary account, as income summary. Again, this account exists for closing sake. What we did here is crediting 10,600. Okay. Cool. Then what's next? Let's close the expense accounts, all of them. Okay. Where do you see expense accounts? Expense accounts are found on the debit sides, right? So to make them zeroed out, you need to credit them. Yes, we need to credit. We need to credit. Something is off. We need to credit. I am copying and pasting the values. Again, what is the shortcut key? Right hand side button and SS. Again, make a copy. And then go there and then press right hand side button and SSV. Okay. And then let's also copy the values. Here, copy and paste. What do? You saw them on the debit side. To zero them out, you need to credit them. We are about to credit them. Then, what's the closing entry? What are the closing entries? You have a bunch of credit sides only. You don't have any debit side. Is it possible? No. Again, let's use the temporary accounts for closing's sake. The income summary. How much should the balance be? It should be sum of all expenses. Okay, sum of all expenses. What we did is C2, we've debited income summary 7740. Right, 7740. Then, what's the difference? How much is the difference? I'm asking you this because income summary itself is another temporary account. So you need to zero it out. Then how do you zero it out? How much is debit total? 7740. How much is credit total? 10,600. Credit is higher. By how much? By the difference between this and that. You should debit 2860 to close it out, to zero it out. Okay, cool. C3, income summary. $28.60. Cool. But now, what happens? You have only standalone debit side $28.60. This is not possible. Oh my, we are in trouble. What shall we do? Here comes the trick. What I'm saying is, what is this number? Well, tell me the business transaction. What does this number stand for? This number is the difference between sales and expense. What is this number? Net income. Yes, net income. This number is. Then this is just net income. And what's the role of net income? Net income increases your, yes, owner's capital. How do you increase owner's capital? By crediting it, yay, right? By balancing it, the income summary balance, the remainder of the income summary with owner's capital. You can close or zero the income summary out by increasing your owner's capital balance. What we did here is owner's capital being increased by 2860. Did you see it? We saw it. Owner's capital increasing by 2860. This part of statement of owner's equity comes from your closing entry. We didn't explain it rigorously, but we are now doing that. Oh. But this is not the end of the closing entries. We need to close what? We need to close owner's drawing, the last piece, right? Where is its normal balance? Debit. Therefore, to zero it out, you need to credit owner's drawing 500. Owner's drawings 500. Credit. Then it's standing by itself. What's going on? What should it do on the debit side? We saw it, right? Owner's drawing, right? Owner's drawing decreases your owner's capital. How do you decrease your owner's capital? By, yes, debiting. Cool. What we did so far is owner's drawing account which began from $10,000, right? Owner's capital, where is it? Which began from 10,000. Oh, sorry about that, capital. The balance, beginning balance, right, has been changed here. C3 being credited 2860. And then subsequently it is debited. C4 by 500. Then what's your ending balance? Owner's capital. Sum of the credit total minus sum of the debit total. It is 12,360. Where is it? 12,360. 12,360. Right. Now you closed everything. Okay. Right. I've used the T accounts for educational purpose, but if we continue using this tabular format of the general ledgers, let's quickly update all the balances. Cash, owner's capital. Yes, we need to update it. Insert. One more or not? I think we can stop it. Where is it? Owner's capital, C3, right? Wow, it's a lot, right? Owner's capital. Has been increased by 2860. 2860, and then decreased by 500, right? So your balance is the beginning balance plus credit minus debit. giving you 12,360 as your ending balance, right? Equipment, notes payable, unearned revenue, they are all permanent accounts, so they are not affected. Rent expense, this is an expense item, and we saw that rent expense is subsequently in the closing entries credited, right? Owner's rent expense is subsequently credited. C2, right? Meaning its ending balance is 0, right? So you can just erase it. Any questions? Oh, this is an online class, so you cannot ask. Okay, so let's just erase it. The same for owner's drawing, it is zeroed out. The same for salaries expense and sales expense, right? I think something is off. Yeah, it says up. And yeah, another expense item. Zero it out. Again, what happened was your owner's capital has been updated to this figure. And everything else below owner's capital, they are zeroed out. They are zeroed out. Your total balance is still the same, although updated, right? Let's change it post trial balance, post closing trial balance, post trial balance. Okay. All right, that's the end of the discussion about closing entries. Okay, let's label it. Let me label it. Closing trial balance. Okay. All right, and then in the next video, we will finish up this chapter talking about correcting entries, reversing entries, and then discussing the classified balance sheet. Okay, see you there.